Good evening, everyone. Thank you for having me. I would note we just violated the coronavirus rules and we just shook hands. And as soon as somebody says, don't touch your face, the first thing I want to do is touch my face. So it's a hard thing. But thank you all for being here. It's great to have such a nice turnout. I thought I'd start just for a few minutes and talk about the Federal Reserve. Some people know a lot about it. Many people don't know a lot about it. I'd like to just give you some background, talk a little bit about education, and then we can sit down and have our conversation and then open it up to all of you. So I've been president of the Minneapolis Fed for 4 years, since January 2016. The Federal Reserve is our nation's central bank. It was created by the United States Congress in 1913. Its basic job is to manage the ups and downs of the economy. So if the economy is overheating, typically you'll see the Federal Reserve will raise interest rates to try to cool things down by making it more expensive for you and me to get a loan. Or if the economy looks like it's slowing down, the Federal Reserve will typically cut interest rates to try to give a boost to the economy, make it easier and cheaper for us to go get a loan and buy a car or buy a house. Now, Congress did something really unique in 1913. They didn't want the central bank simply housed in Washington, D.C., in the political center of the country. They wanted to make sure all of the regions of the country were directly represented in the policy process. So they created 12 independent Federal Reserve banks and scattered them around the country, the ninth of which is here, the Minneapolis Fed. And our jobs at the Minneapolis Fed are literally to represent all of you. We represent Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. And a big part of our jobs, and my job, is to travel around the region and make sure I know what's happening in our regional economy. So that when I go back to Washington, D.C. every 6 weeks, I'm going in a week and a half, when we have these interest rate meetings, FOMC meetings, you might read about them in the paper, part of what I'm doing in those meetings is I'm talking about what's happening in the regional economy. I'm also talking about what's happening in the national economy. You know, we can't set a different interest rate for Minnesota or California or New York. We all use the same dollar, so it's one interest rate for the whole country. But we want to make sure all of the different regional variations are considered and debated as we set interest rates for the country. So that's my job. And so that's why these opportunities are great for me, because it gives me a chance to directly hear from people what's happening in your neighborhood. What's happening in the local economy? Do folks have work? Do they have jobs? Are wages climbing? Are businesses able to find workers? Now, part of what we do in monetary policy is we're trying to trade off these two goals that Congress has given us. One goal is stable prices. Think of an economy that's not overheating, but also not limping along, kind of steady growth. The other goal is maximum employment. As many Americans as possible who want to work are able to find jobs. Usually we think those two things are linked like a seesaw. If the economy heats up, unemployment rate falls, businesses have to compete to find workers, that leads to higher wages, and that leads to inflation. So we're trying to balance these two sides of the seesaw. Well, something remarkable has happened the last 4 or 5 years. There's been no inflation. Inflation's been low. Every time we thought we're running out of workers, the economy's overheating, it wasn't true. All these workers came off the sidelines and took jobs. So the unemployment rate has fallen from 10% in 2009 to around 3.5% today. Usually with a 3.5% unemployment rate, you would think, wow, we are way beyond full employment. Wages are going to be skyrocketing. Inflation's around the corner. It hasn't happened. Why hasn't it happened? It hasn't happened because that 3.5 or 3.6% unemployment rate only includes people who are actively looking for work. If you gave up because the Great Recession was so devastating, you're not counted as unemployed. Isn't that weird? So it turns out there were a lot of people on the sidelines, not counted in that unemployment rate. And as the economy has gotten stronger and as wages have slowly climbed, people have come off the sidelines. They saw their neighbor or their brother or their sister or their uncle get a job and say, hey, you know what? That looks pretty good. Maybe I will go get a job. And so we don't know how many more people are out there that still want to work that are not yet working today, but they've been a big engine of economic growth that's allowed us to grow without having overheating or without having inflation. So over the past, since I've been at the Fed, I've been probably the strongest advocate against raising interest rates, just because I did not see any evidence that the US economy was overheating. And we'll talk about it. Obviously, we cut interest rates this week, which I know Bob is going to ask me about. But we'll talk about that with you too. One other thing, and then I'm going to sit down. The Minneapolis Fed for a long time has done a lot of work on education. Now, we don't set education policy, obviously. We're not the education department. But there's no more important determinant of your success in the job market than the education you have. If you have more education and better education, you will have more job opportunities and you will have higher wages. That's almost a universal truth. And so we care a lot about understanding education because that tells us what's the potential for the US economy to grow. If more of our neighbors have good education, our economy is going to have a higher potential growth rate. So we care a lot about education. So the Minneapolis Fed for 15 years has done a lot of research on the value of early childhood education. Thank you. And this predates me, so I'm not taking credit for this. Our research is just clear that $1 invested in early childhood education, especially for low-income families, has profoundly positive returns to society because that child is a more productive member of society, earns more, pays more taxes, it pays for itself. One of my big surprises moving to Minnesota 4 years ago, Minnesota has so many strengths, but one of my big surprises moving here was to discover that Minnesota has some of the worst education achievement gaps in the country. We're talking about the difference between low-income kids and well-to-do kids and children of color and their white counterparts, some of the biggest gaps in America. And I didn't understand that. I mean, it really was surprising to me when I discovered it. So I challenged our economists at the bank, help me understand this. Why do these gaps exist? What's been done? What's happening in other states? And what we discovered is there have been lots of attempts over the last 20 years around Minnesota to try to close these gaps, but we've made zero progress. Today, the state published new data that graduation gaps are closing. More and more Minnesota kids are graduating high school. That sounds great, but if you look below the surface, their actual preparation is not getting any better. We could graduate everybody tomorrow and accomplish nothing, and that's the path that we're on right now. So we need to be honest about that. So what I realized is that it seems like politics is getting in the way. That people, what I've learned is that one party has a certain set of solutions that they prefer. The other party has a different set of solutions that they prefer. They don't agree. And so we're kind of at a stalemate. Meanwhile, other states have made real progress in closing these gaps. So this problem is not impossible. You can do it. It just requires really, truly putting children first. So about a year ago, a little more than a year ago, I reached out to former Minnesota Supreme Court Justice Alan Page. I reached out to him both because I knew he spent 22 years on Minnesota Supreme Court, and I know that he has a lifetime of passion about education. And I asked him, I said, is there a way we could use the law to truly put children first, to break through the logjam and really drive change that puts kids first, that leads to better outcomes? And he said yes. And we then began a year-long journey of developing an amendment to the Minnesota State Constitution that would make a quality public education a civil right for all children. Now, we looked at, I'll show you, maybe you can put the slide up. We have a current education provision in the Minnesota Constitution. It's on the right. This provision on the right was written in 1857. Many other states around the country have updated their education clauses from modern times. This was written in 1857, and it basically says you or your child have the right to an adequate education system. Who here wants an adequate education for their child? Well, do you know what an adequate education system actually means? It's a system that's great for some and lousy for others, and on average it's adequate. And your guess is as good as mine where your child ends up in that spectrum. Well, what we did is we looked at the other 49 state constitutions and said, what can we learn from other states? And let's take the strongest elements from other states. And that's our proposal on the left, an equal right to a quality public education. Basically, this is saying all children have a civil right to a quality public education, and then it holds the state accountable to outcomes. It's not pro-Republican, it's not pro-Democrat, it's pro-child. And all solutions are available that help children to learn. So we are busy advocating for this. We have a lot of support. It was introduced in the House last week. 10 Democrat authors, 20 Republican authors are behind it. Right now, our biggest opponent, I'll just be blunt, and I'm surprised and disappointed, our biggest opponent is Education Minnesota, the teachers union. I think the people who oppose this are afraid of giving up control. Because if you create a civil right so that families have power, there are people who will lose power. And so right now we're confronting this challenge of saying, let's truly put children first. So we'll get into more of this, but I wanted you to know about this. Justice Page and I are spending a lot of time trying to educate people about this. And as you said, there's been a bipartisan group, an independent group that is formed called Our Children. They have a table out front that are actively advocating for this amendment. So I'm sure you may all have questions, and we can talk about the questions during the Q&A. But thanks for being here. I'll turn it over to you, Bob.
All right, thank you. So lots of stuff there, and I'm going to start with this. So it's been an interesting week if you watch the stock market, hasn't it? And the Fed, actually. And I, as I was preparing for this, I was reminded of a saying that I've heard: the stock market is not the economy. You may have heard that before. But earlier this week, right after a steep decline in the stock market, the Fed reduced the interest rate by 0.5%. So it sort of looks like they were responding to the stock market. And that, even though many economists have said the underlying economy of the United States still seems pretty strong, or at least maybe before coronavirus gets here. So can you explain the reasoning behind that emergency reduction in the interest rate? And then maybe a little more generally how the Fed deals with particularly the short-term but maybe longer-term influences on the economy?
Yeah. Well, for me, my rationale, so I voted in support of cutting interest rates, the 0.5 percentage point that we did on Tuesday. I view this as insurance, which is, first of all, we all know, obviously, interest rates are not a response to a virus, right? Clearly, this is a medical crisis, a medical emergency, but we also know that with businesses pulling back travel, businesses pulling back, supply chains getting disrupted, it can have spillovers into the economy. And while this is predominantly a healthcare situation, the Fed does have a role to play in trying to support the economy. And so even if we're not the first responders or the primary responders, we want to do our part in the part that we can influence, and that is we can help support the economy. So for me, this was an insurance that we took out because nobody knows how bad the virus is going to be. There's tremendous uncertainty. Businesses are facing tremendous uncertainty. In the face of uncertainty, businesses tend to pull back. If everybody gets scared and everybody pulls back at the same time, that itself can lead to a recession. And so to me, the erring on the side of taking out a little insurance now was prudent. Because if it turns out that the virus was not so bad and it passes and the worst fears are behind us, we can always raise interest rates in the future, right? That's easy to do. If it turns out that the virus is really bad, then we may have to do more. So we just don't know at this point. And so to me, it was not that difficult a decision to take out a little bit of insurance right now to try to support the economy.
Okay, great. And then sort of other things besides what's going on right now. I'll take, for example, President Trump's tweets about what interest rates ought to be and some things. How does the Fed deal with, and those are probably pretty easy, it's like we ignore that, but there's some other things going on in the economy. So we'll take tariffs, for example, which also can have be pretty impactful on the economy. Yeah. So how do you deal with things like that?
So there are all sorts of things that we consider to be shocks or inputs into the economy that we need to factor in that we can't control. So tariff policy is an example. If all of a sudden U.S. and China ratchet up tariffs, that's going to change the way our economy behaves. That's going to change how competitive we are. And then we have economists running very sophisticated computer simulations of all these different possible outcomes to say, what does it mean for U.S. economic growth? And does that mean there should be higher interest rates or lower interest rates, or maybe it has no effect? Maybe monetary policy is indifferent. Another example would be Brexit, which has gotten a lot of attention. We consider that to be a potential shock to the U.S. economy. And so that's something else that we model in and factor. Some of these are easier. So tariffs are pretty easy to model. If our tariffs go up 20% and China's tariffs go up 20%, we can do the math on that, on what that means. It's some things that are harder to predict is if they have a nonlinear response. So if it looks like the trade war with China was just getting out of control, the tariff dollar itself may be limited. But if everybody gets spooked because it seems like we're in an unending trade war, then that can be you can get a disproportionate pullback. That's very hard for us to model out because part of the economy is math, part of it's human psychology, part of it's mass psychology. And trying to estimate all that is a very inexact science. So the reason that coronavirus, part of the reason that it's so disruptive right now, is no one knows what the future holds. And we don't know, is this going to be a few months and then it'll be behind us, or is this going to be more severe and drawn out? And it's that uncertainty that creates uncertainty in financial markets, but it creates uncertainty for policymakers too.
Okay, great, thank you. In earlier Headliners events, we've had speakers here who have talked to us about the inner workings of the Supreme Court. So I'm wondering if you could talk a little bit about the inner workings of the Federal Open Market Committee and how you all go about making decisions about interest rates.
Sure. Well, there are, 12 Federal Reserve Bank presidents, and there are five to seven governors in Washington, D.C. They're appointed by the president. So let me just give you a little more information. I was appointed by a local board of directors of regional leaders. I was not appointed by the President of the United States. I can be fired by my local board of directors. I cannot be fired by the President of the United States. The governors in Washington are appointed by the president and confirmed by the Senate. The reason they wanted the reserve banks to be independent is they wanted us to be removed from the politics of Washington, D.C. So all of us get together every 6 weeks to set interest rates for the nation. About a week and a half in advance of that, we get about 100 pages of economic analysis from the economists in Washington, D.C. Our economists in Minneapolis do our own economic analysis as well. I spend about a week with my economists in the week before our meeting, going through the analysis we get from Washington, going through our own analysis, running our own scenarios, debating what the outlook is for the regional economy and for the national economy. Then we go to the meetings. The meetings are 2-day meetings taking place Tuesday and Wednesday. And they're very structured. People are very, very well prepared. Politics literally never enters into it. It's 100% about everybody saying, here's what we think is right for the US economy. And then at the end of the 2 days, there's a vote. And we rotate on who votes. So I'm a voter this year. I don't vote for 2 years, and then I'm on for a year, and then I don't vote for 2 years. I rotate with the Kansas City Fed and the San Francisco Fed. It's just a quirk of history that that's how the rotation is. And then we take the vote. And then it's a vote. And then depending on how the votes go, then that says what we do for interest rates.
And so it's a majority vote wins?
It's a majority vote wins. I'll say the chair of the Federal Reserve System, his name is Jerome Powell, Jay Powell we call him. Before Jay Powell was Janet Yellen, and before Janet was Ben Bernanke. They lead, right? There's a lot of deference given to the chair. And we really respect Jay Powell. We really respected Janet Yellen. And if they want to lead the committee in a certain direction, there's a good chance the committee is going to follow them. So in 2017, when I was voting, I voted no. I dissented against all 3 interest rate increases. I was the lone dissenter in 2 of those, and 2 of us were dissenting, me in Chicago, in the 3rd one. But if I'm the lone dissenter, guess what? We're raising rates. So, one vote against does not carry the day.
Okay, great. Thank you for that. So I do want to spend a little time talking about the proposed constitutional amendment, and thanks for describing that a little more carefully and sort of why you and the Fed are interested in that. And many of you will know that Education Minnesota has come out fairly publicly against that. And you described it as power and so forth, making it sort of sound like a zero-sum game. So is there a way around this so it's not zero-sum, so that both Education Minnesota feels good about it and other opponents, but also people promoting it and the students end up winning?
Well, we actually, Justice Page and I don't think of it as a zero-sum game. We actually think that, so right now our standard in Minnesota, the legal standard is an adequate education. We want to raise the standard. We want to raise the floor to quality for all children. And if you can go beyond quality to super duper quality, fabulous. But at a minimum, let's establish a floor of quality. Education Minnesota has said their highest priority is more funding for schools. Well, guess what? Quality costs more than adequate. So we actually think that if their goal is to get more funding for schools, this amendment will support them in their initiative to go do that. So we actually think that they should be for this. But the arguments that they've offered, I'll just tell you, you can Google it yourself. They've said that this is going to lead to vouchers for private schools. By the way, Attorney General Ellison is supporting this. Attorney General Ellison says, this says public education 3 times. There's nothing about this. This is private schools or vouchers. So, and that's the Attorney General's position, not just my position. So, the arguments that they're offering don't make any sense.
Okay. You probably will get more questions about that. Let's talk about climate change. It's increasingly in the forefront of public policy and the economy. So how does the Fed factor climate change into its decisions?
Well, it's complicated. I mean, we certainly think about, one of the things we do that I haven't talked about yet is we regulate banks. And we need to make sure that banks are running in a safe and sound manner and that banks understand the risk that they're taking. So we know that, let's say, hurricanes can be devastating for financial institutions that are lending into those markets. So there's a extreme weather event angle to this that directly affects how we think about bank supervision and making sure banks are properly accounting for their risks. That one's a little bit easier for us to get our hands around. The harder one is, does monetary policy, should climate change enter into our monetary policy deliberations? That's harder for me to figure out because when we are forecasting the US economy, we're forecasting the next 3 to 5 years. We know the climate is changing, but it's changing over a longer arc. And so it isn't obvious to me that the forecasts of climate change are going to affect where we set interest rates today. It just feels to me like it's a different time horizon. The weather events are clear, monetary policy is less clear to me.
Okay, great. And my last one, and then get your questions ready. After this, you'll have your chance. Federal Reserve Bank of Minneapolis created the Opportunity and Inclusive Growth Institute. You talked about that a little bit. It's a research center dedicated to investigating issues of social and economic equity. So you talked about this some, but maybe just a little bit more about, sort of your rationale, why the Fed is concerned about that.
Well, it comes back to maximum employment. Like, why is it? I'll give you an example. One of the things I also learned when I came to the Fed, in America, African American unemployment is almost always twice white unemployment. 2x. It's pretty constant. If it's a booming economy and white unemployment is 4, African American unemployment will be 8. If it's a terrible economy and white unemployment is 8, African American unemployment will be 16. So I started asking our economists, why is that so constant? And by the way, that's true high school graduate against high school graduate, or college graduate against college graduate, or high school dropout against high school dropout. It's almost always 2. It's starting to close ever so slightly right now because the labor market is tighter. So they're very basic questions about economic disparities that we frankly don't have good answers to. I mean, clearly, people aren't getting the same education. That's part of it. Discrimination is clearly a piece of this. What are the other factors? And so I challenge our economists to help me understand what are at the root of some of these different outcomes. Even if we can't close these gaps with the tools that we have, if we can arm other policymakers with the best research available, then they could use it. So, earlier I talked about early childhood education. There are thousands of children in Minnesota today who have scholarships to high quality early childhood education, in part because of the work of the Federal Reserve before I joined. We don't set education policy, but we're really proud that we could do the research and arm legislators with the information so that they could put it into action. We don't know what's going to come out of our new research institute, but we are excited to do our part and do our work.
Okay, great. Thank you. So I'm going to step off the stage here in just a moment and let Neel fend for himself up here. Again, for those of you who have been here, you know the drill. We have microphones that will get around to you for you to ask questions. Raise your hand and we'll get someone to you. As always, I know there will be lots and lots of questions, so please keep your questions brief so we can get to as many of them as possible. Remember, not only are you being live streamed, but we're also recording for a podcast, so hold that microphone just a couple inches from your mouth. Speak clearly, not too quickly, but quickly enough for us to get through a lot of questions. And let's have some fun with this. Go ahead, right here.
Yes. Late last year, the Fed started intervening in something called the repo market. I'm wondering what that is, what it does, what's the significance that the Fed had to intervene, and what do you think about the recent attempts to taper off that intervention?
Okay, there's a lot under your question. After the financial crisis, the Fed did something called quantitative easing, where they expanded the Fed's balance sheet. The reason they did that was they were trying to drive down long-term interest rates by buying long-term treasury bonds. How do we buy bonds? We create something called reserves, which are basically money that banks trade with each other. We have the license to print money, so we created money and bought these bonds. Well, eventually, so we ballooned it up to around $4 trillion of our balance sheet, and then we said, well, let's shrink it back down to a smaller level, knowing that it's not going to go back to as small as it was in '08, just because the economy's been growing, and for other technical reasons, we know it would be bigger than it was in '08. So we were gradually letting that balance sheet shrink back down to normal. We weren't quite sure how low we could get it to go, and without losing control of interest rates. So what ended up happening last September is it turned out the demand for those reserves was greater than we had expected. And all of a sudden, interest rates started going much higher than we were programming with our policy. So we set an interest rate we make a decision. The committee says we want interest rates to be X, and then we try to transmit those across money markets, as it's called. So what ended up happening is interest rates started climbing higher than we had intended, which told us, hey, we shrunk our balance sheet a little bit too far. So then we went back in the market using a bunch of different operations. Repo is one of them that you just mentioned, as a way of putting reserves back into the financial system so that we got control of money market interest rates again. Some people said, oh my gosh, it's quantitative easing. It was not quantitative easing because we were not buying long-term bonds. We were simply putting more reserves in and taking short-term treasury bills out. But that was simply about making sure. So we set an interest rate, like the committee says, we want interest rate X. That's right for the economy. Then we need to make sure that that interest rate gets transmitted to different financial markets. And that's what this operation was about, was to make sure that our policy was getting transmitted effectively into other parts of the financial system. Thank you.
Okay, Anastasia has one over to your left there.
When we file our income tax this year, there's some new questions, and I'm just wondering if those questions came from your organization. The questions are basically asking you, do you have any money overseas? Are you investing in any kind of special coins? And I was just kind of curious if those are coming from your organization or if it's strictly from taxes.
No, it would just be, and just thank you for asking the question. So the delineation between monetary policy and fiscal policy. So fiscal policy is how much we pay in taxes and then what those taxes get spent on, be it healthcare or education or defense. That's the domain of the Treasury Department and Congress. We just handle interest rates going up and down, which is separate. So no, that was not us.
That's a nice question to be able to dodge, isn't it? It's like, I'm not
but it wasn't a dodge, right? It was
3 days ago, the Fed cut interest rates by 0.5% to a range of what, 1 to 1.25% is your target. If you do that again twice, you're down to 0. What are the implications of that or 0 to 0.25% or something? If the rates get to 0 or go below 0, what are the implications of that? It just doesn't leave you much room for further cuts in interest rates. And given that if the coronavirus turns out to be really, really serious, you just don't have much room to cut further. What are you going to do?
Yeah. Well, we have other tools available. So whatever the shock would be, whether it's the coronavirus or it's Brexit or it's some other economic slowdown, people have wondered, what will happen to central banks if they end up going back down to 0? And I think what we would likely do is then turn to some of the other tools that we use, such as quantitative easing, to try to drive down long-term interest rates. Let me explain this for a second. So the interest rate that we move up and down that gets a lot of attention in the press is an overnight rate that banks charge each other. Now, you and I don't care about an overnight interest rate. What do we care? We care about long-term interest rates, because if you go get a mortgage, a 20-year mortgage, a 30-year mortgage, you care about the interest rate over that mortgage. Or a car loan for 5 years, you care about a 5-year interest rate. Well, the reason we move short-term interest rates up and down is by moving them up and down, they actually have some effect on long rates. And so it's actually the long rates that drive economic activity. So even if we move the short end, short-term rates down to 0, ultimately what we would be trying to do is move long-term rates down to try to provide more economic stimulus. And that's where we could turn to. There are two things that we used in the last crisis that we now have more experience with and I think more confidence in. One is quantitative easing, so buying long-term bonds to drive those long rates down. And the second is something called forward guidance. Forward guidance is this. If I tell you, in an example, if I tell you we're going to hold rates at 0 for 10 years, that 10-year interest rate is going to be pretty close to zero. And the more definitive I make that promise, the closer it'll be to zero. So by us making statements about the future and commitments about the future, we can actually influence those long-term rates. That's what we call forward guidance. So there are a number of different tools we have available. We would love to have more traditional interest rate room to move up and down, but we are where we are. And let me just spend another minute on this because this is really fundamental. Interest rates around the world have been declining for 30 years. So there's a key concept in monetary policy, which is what is the neutral interest rate? What interest rate neither stimulates nor restrains the economy? You know, we don't set the neutral rate. The neutral rate is set by the economy itself. It's set by things like demographics and technology development and productivity and how much people are saving. So this neutral rate has been declining like this slowly for 30 years. We move interest rates up and down around that neutral rate to either stimulate or slow the economy down. But we don't set neutral. So we are where we are, close to zero, 1% or so, because the neutral rate is low. That's why Europe is at zero or negative. That's why Japan is at zero or negative. It's not that all these central banks got together and said, hey, let's just drive rates lower. It's that these broader macroeconomic forces are affecting the global economy, not just the US, so we have to respond to that. Long answer to your question, but there was a lot under your question. Who's got the mic?
Anastasia, we're on the left there.
Okay.
I have two questions. One is, what's going to be the effect when our national debt is equivalent to our gross national product, and should we even have a debt ceiling in Washington? And secondly, on your amendment, how are you going to measure the outcome? Last month we had a talk about children who are born essentially disabled in a sense by maternal malnourishment, by maternal deprivation, vitamins, iron was a big one. And that kid, and then I asked about if the child doesn't learn to read by the third grade, will he ever be an adequate reader? And the answer was probably not. So how are you going to measure the outcome, and where are we going to intervene? I'm great for this early intervention, but I don't know what this is going to result in other than a lot of lawsuits if you don't have a good way to measure it.
Okay. First part of your question, I'm sorry, I got stuck on education. The national debt. So right now, the US government and advanced economies are borrowing at very low rates. So right now, investors are saying they still have confidence. They have a lot of confidence that as dysfunctional as our politics may seem, they have a lot of confidence that the US government has enough wherewithal to pay back its debt. So the US government is borrowing at 10 years at around 1% now, which is very, very record low levels. At some point, we know if you just plot out the forecast of our national debt, they grow almost exponentially. And they grow that way because we're having fewer children than prior generations. Our programs, like our entitlement programs, are funded by current workers paying for current retirees. And so that ratio is going into the red. And as our society ages and we have fewer children, the math just is what it is, and the net result is the deficit goes through the roof. We know at some point, this can't go on forever. Investors will say, hey, we're losing confidence, and you'll see that show up in inflation and higher interest rates, and eventually the bill will come due. But are we 5 years away? Are we 25 years away? We just don't know. So right now, I'm not worried about the national debt. I think if the US government said they want to go spend $1 trillion and do a big infrastructure plan, they could easily go finance that. But at some point, we do have to make decisions on how to get into fiscal balance. And by the way, personally, I'm in favor of more legal immigration as a way of boosting economic growth and boosting our labor supply, which can also help bring some of these programs back into balance. So that would be my choice. But so now on to your question about what do you measure. So the measurement, right now we have standards in Minnesota schools today. And for many kids, we don't meet the standards. And Justice Page and I are not proposing to change the standards. The standards are set by the people through their elected representatives. So what will happen if this was passed? Those standards will likely change. They will get a lot more scrutiny. A lot more people will be part of the process to make sure that details of different communities can be woven into that. And then we want to hold the state accountable. Now, there's no question, not every child is going to learn calculus, right? Different children have different capabilities. Justice Page, who I'm leaning on because he's spent 22 years on the Supreme Court, and I'm not a lawyer, so you know what, his legal opinion counts a lot more than mine. He says a court will look at this and say, did this child have the chance to reach his or her potential? Recognizing that potentials are different for some of the reasons that you said and otherwise. If you look around the country, many other states have updated their constitutions. It has not led to an onslaught of litigation. But you know what? Think about a landmark civil rights case in America, Brown versus Board of Education. That case was about education, separate cannot be equal in education. But Justice Page, if he were here today, would tell you very passionately about how that one case ended state-sponsored segregation across America, not just in schools. That's the power that we're talking about here. If the people pass this, what will the education system look like 20 years from now? I don't know. This can lead to transformation, but it will be centered on the child.
Okay, I have one right up here.
On your education amendment again, how will you breathe life into it? It's just words on a page. Will somebody sue because the children are not receiving an adequate education, and then they'll be under court, the district or the state will be under court order to comply?
Well, what we think will happen is we've met with many leaders in the Capitol, both sides of the aisle, both parties, and we think that this will catalyze them. Many legislators have told us, we don't want the courts doing our jobs for us. And I say very respectfully, well, you've had 20 years, okay? Well, we think this can be a catalyst to say, hey, it's time to truly put children first, put your politics aside, take decisive action, and if you take decisive action and really improve outcomes for kids, there's nothing for a court to do. So it's a little bit of a carrot, a little bit of a stick, a little bit of a threat, that if you don't do your jobs, then you're right, families might go to court and bring an action, and then you may not like what the court ends up having to say. And the thing is, again, going back to the way civil rights works, if one family brings one case, it can drive change for everybody. Think about the right to free speech. We each enjoy the right to free speech. I have never needed a lawyer to defend my right to free speech. I've never needed to go to court to defend my right to speak my mind. Because everyone knows I have the right to free speech, and everyone knows you have the right to free speech, and you have the right to free speech. That's the power of civil rights. You don't need to go to court if everybody knows it's in the Constitution. I mean, you might need to, but there's a good chance you don't. And here's the last thing I'll just say. I mean, you can ask me more questions about it. You know Einstein's famous quip, that insanity is repeating the same behavior and expecting a different outcome. We've had decades of this. And we've got zero to show for it. Zero. So I always challenge people, you don't like our plan? Okay, great. What's your plan? And what are the odds that your plan is really going to lead to transformation in 20 years, let's say? So far, I've heard crickets.
Okay, I have one back here.
Okay. Does the Federal Reserve have the ability to significantly influence affordable housing in local areas?
Not directly. I mean, we do regulate banks and make sure that banks are providing credit fairly in different areas and different communities. So that's one angle that we have to try to influence that. We also do a lot of research on affordable housing. Everywhere I travel around our region, affordable housing is one of the top topics that comes up everywhere. You know, red district, blue district, it doesn't matter. Big city, rural community, doesn't matter. So there's something that we do a lot of research on. Basically, what we've concluded is that there are a group of folks who basically have an income problem. They just earn very little, and they're going to need a subsidized place to live just because they just don't make enough money. But there are many other folks for who also have affordability challenges, and there's just not enough money in the state coffers or the federal government coffers to subsidize everybody's housing. So we have to find a way to mobilize the private sector to build a lot more supply. We are simply not building enough homes, units of any type, to try to meet the demand. And so prices are going up and up and up. Go ahead.
Is there a way you can mobilize the private sector more than what's happening now?
You know, we're trying. It's hard. It's not simply mobilizing the private sector. It's also mobilizing local government, because a lot of the barriers that are put up are imposed by local governments for very good reasons, like good intentions. I'll give you an extreme example. Not in Minnesota. California passed a law mandating that every new home have $10,000 of solar panels on its roof. All right, that directly affects affordability for low-income families. It directly increases the cost. Now, you could have a minimum lot size. You could say minimum 2-car garage. You could say minimum number of bathrooms. You could say all these things, some of which, you know, you want a safe place to live. You want basic insulation standards, et cetera. But there are many other regulations that we've observed that are layered on top of it that drive up the minimum cost, which affects affordability. So, you know, we're trying to do our part to educate local policymakers so they realize that, hey, they may have a really nice idea in isolation, but when you add it up to all the other really nice ideas, it really is affecting affordability.
Okay, Anastasia, again over on the left.
What is your view on the role of the Federal Reserve with cryptocurrency?
You have a question?
Well, I'm pretty outspoken on cryptocurrency. So I was more optimistic about it several years ago. And then I watched over the last few years, and people have been fleeced out of tens of billions of dollars. It's basically the wild, wild west of con artists and hucksters ripping people off. And so far, I have not seen anything worthwhile come out of the entire sector. It's just been one ripoff after another ripoff. So now I'm speaking out very bluntly, obviously, to try to warn people. You know, I'll give you an example. A couple of years ago, I was flying through, my wife's from the Philippines. We flew to the Philippines. We came home. We went through customs at Los Angeles airport. And the customs agent asked me, he said, oh, you work, where do you work? I said, the Federal Reserve. He said, oh, do you know about cryptocurrency? Do you know about Bitcoin? And I said, well, I know something. He said, well, my good buddy just took out a home equity loan to buy Bitcoin. Should I do that? Yeah. And I said, you know, I'm not supposed to give you investment advice, but no, do not do that. Okay. So look, 20 years from now, is it possible that there's something useful that could come out of this? I'm open-minded. It's possible. But right now, there are thousands of these coins that have been created. I can go create Neel coin, and you can create your own coin, and you can create your own coin. And they're all indistinguishable from each other. The reason that the dollar has value is because the US government has a monopoly on producing dollars. If you try to produce your own dollars, you will go to jail. But that scarcity is what gives people confidence in it. And so the cryptocurrency, it's just the wild, wild west of garbage coins. And so, again, 20 years from now, will something useful come of it? Maybe, but I'd be careful.
Okay, so we all got investing advice tonight, right?
Hi, I'm a geologist that has a economics question for the rocket scientist.
Okay.
So I'm interested in what they call external costs. And what external costs, as I understand them, are it's when there's a cost of doing business that an industry is not paying. It's a cost that that everyone else has to pay, just because of that. So, and it's also my understanding that these, when you have an industry with these external costs, it's less efficient. The whole economy is less efficient because it makes products less expensive than what they actually are. So my question is, should the energy and the agriculture industries be held responsible financially for the carbon dioxide in the air and the contamination of groundwater that they're responsible for? And how would that be accomplished? And maybe they should be paying for those solar panels in California.
Right. Well, that's the whole theory behind a carbon tax. So the premise of your question is right. But economists call it an externality, but it's exactly what you said. It's an external cost not borne by the producers, yet it's borne by society. And the economic theory says, do your very best to account for those costs, and then you charge a tax equivalent to that cost on, let's say, a per gallon basis of gasoline or per pound of coal or whatever else. So that's the theory behind a carbon tax, is that if you made all the producers of the carbon dioxide actually account for the actual cost that society is bearing, then they would produce less of it. They may not produce zero. Zero may not be optimal, but it would end up being lower because they're bearing the full cost. And so, I mean, that's a very sensible economic way of looking at this. I think the challenge is it's a political challenge. It's not an economic challenge. I think most economists, you would ask and say, what's the optimal way of dealing with climate change? It would be a carbon tax. Most would say that's...
What about the groundwater and agriculture? It's a big
Well,
deal in this state.
Yeah, I mean, I think that you could do this analysis on any number of industries, that if there are costs that are being borne by society, that economists would say the optimal way to do that, add up those costs and charge it as a tax back to the producer, and then the economy will work itself out. Again, you won't take agriculture to zero, but the mix of what they're planting would probably be different, as an example.
Okay, I think, do we have a Totino student back there ready to ask a question? All right.
Okay, so I was wondering what the impact that the Federal Reserve has on FAFSA rates, because like right
On
now,
what rates?
FAFSA. So we're paying interest rates, like me and I know the two other people sitting next to me, and then she's a mom of somebody who's graduating this year. It's like 4.53 or something %, and we're given X amount of money, like from the Fed or from FAFSA. So like, how is that regulated by the Federal Reserve, and what's the pertinence of that on economy? Because it becomes increasingly more difficult the higher education you get to actually be able to afford your loans.
Yeah, so it's a good question. You know, the student loan market is really right now controlled by the federal government. And I'll be honest with you, I don't exactly know how they determine that interest rate that they charge you. But I know it's controlled by the government, whether it's the Department of Education or some other agency, I'm not sure about. The broader point that you're making is exactly right. I mean, right now, our education model, you know, supply and demand, if you demand more of something, the cost is going to go up. More and more young people are understandably seeking higher education. We need to find a model where we can educate more and more of our young people with more years of education without just driving the costs up through the roof and without just saddling them with student debt. I mean, one thing that happened in the financial crisis, state budgets got cut dramatically because of the downturn in '08. So the outlet were student loans. Because they said, you know, well, we can just cut back on the universities and the students can just take out bigger and bigger loans. That was the safety valve for state budgets all around the country. And so that's part of why you've seen student loan debt grow as much as it has. So I don't have a great answer for you in the short run, but I would say in the long run, we have to be looking for new models of delivering education so we can reach more students at lower and lower costs. And I know there's a lot of experimentation going on at the U and in leading universities around the country, but we have to do it because education is only going to become more and more important. And we know if all of our young people are saddled with student debt, it's going to push off buying homes. It's going to push off buying cars. There are other economic implications for all of us if the debt levels just keep going up and up and up. Thanks for your question.
Okay, I have one back here in the aisle.
Sorry, I actually had a very similar question that I had in mind. So yeah, as you were talking about with total student loan debt increasing, given that figure, which I believe is well over $1.5 trillion, which is larger than even all outstanding credit card debt in the U.S., do you think that if the student, or yeah, if you think that the student loan market, if you think that it would collapse due to the amount of debt increasing, and if it were to collapse, do you think that it could cause economic implications as severe as what we saw in 2008 when the housing market collapsed?
So no. So the housing market was $11 trillion, the mortgage market, $3 trillion of commercial, so about a $14 trillion market, so a much larger market. And part of the reason is that there's so much leverage underneath the housing market. The student loan situation is a serious economic situation. I don't view it as a systemic risk that could bring down the whole U.S. economy, frankly, because the U.S. government is guaranteeing a tremendous amount of that debt. And so I think the U.S. government has the capacity to support that. The implications will be, you know, tough on the individual and what it means for their ability to buy a house and whatnot. So I do think student loan debt is a serious issue. I don't see it as a systemic risk issue as we saw in '08. I'd also say you hear these stories in the media where, you know, one student has $200,000 of debt or $250,000 in debt. Those are far and away the exceptions. The vast majority of students who have student debt have $15,000, $20,000, $25,000 of debt. I'm not saying that's trivial. It's still meaningful, but it's not like the vast majority of students are walking around with $200,000 of debt. That is simply not true. even though those are the examples that get showcased in the media a lot.
Okay, I have a question up here in front again.
Yeah, I'm wondering what your take is on feedlots in your travels around.
What?
Feedlots for
Feedlots.
raising cattle.
Okay.
You have to come across these things as you travel around your district.
I've never gotten a question about them before.
Well, it's a good example. Short-term economic thinking, people have jobs, profits are being made. That's short-term economic thinking. What about the long-term economics of it and externalities, as were raised earlier?
So can you explain to me what is the externality of a feedlot? I don't know enough about it.
Well, what I'm asking, when you travel around the district, what's your personal reaction to feedlots?
Well, I mean, hold on. What's your personal reaction to feedlots?
There's dinner tonight, right? So it's like, but yeah, the externalities would be around water pollution and air pollution in some cases for the massive feedlots. I mean, that's part of the controversy.
I'll just tell you,
feedlots.
when I travel into farm country, mostly what I hear from farmers, number one, they've been suffering from low commodity prices for many years now. Number two, they're anxious about the tariffs with China, which is exacerbating the low commodity prices. Number three, many of them are concerned because they can't get the labor that they need to work on their farm. So I'm just telling you, those are the top three things that come up when I travel around our ag sector, and I do it a lot. But now I'm going to keep my eyes open and ask more questions about feedlots. I understand.
Okay, we've got one over here with Anastasia.
Back to the public education amendment for a second.
Yeah.
You've done a very good job of convincing us it's a terrific idea tonight, and it sounds like a great idea. And yet, the teachers union has come out against it. I want to push back a little bit on your comments about the teachers union. Are you in discussion with them and trying to allay their fears in any way? And also, I love teachers, and questioning their motivation might not be the best way to...
I'm not questioning teachers' motivations.
Well, the teachers' union motivation, their spokesman.
I'll just tell you. I mean, I've told other people, so I'll tell you. We met with them very early on, and we said, we'd love for you to be part of this. And they said, this is really interesting. We'd like to work with you. We said, great. They said, we may have some language suggestions. We said, hey, we're open to making it better. Bring us your suggestions. And 2 weeks later, they came over and said, nope, we're going to fight you on this. It was a 5-minute meeting. So the official arguments they've said are this is going to lead to vouchers for private schools. Again, Attorney General Ellison says this says public 3 times. There's nothing about private schools in here. That's nonsense. Number 2, they said, oh, this is going to lead to less funding for schools. This makes education a paramount duty of the state. That means the state would have no higher responsibility than funding quality public schools. But they said it's going to lead to less funding. And then third, the argument was, oh, only rich families can take advantage of this because they can afford lawyers. That's not how civil rights works. Civil rights cases are brought by poor families. And one case can lead to change for everybody. So to me, and the other resistance that we've gotten are from some other leaders in the legislature, I'm not going to name names, and they're like, hey, we want to control the solution. And I say, great, why haven't you done it?
Okay, one in the middle here.
So back to macroeconomics. It's often said the economy's doing great. It's often said that we have some real problems. And in that second category, there seem to be 2 issues. One is maldistribution of wealth and well-being. Second gets a little more complicated, and it is that we've never really recovered from the 2008 Great Recession. Our central bank balance sheets have been bloated in order to sustain the economy. Inflation rate is stubbornly low. We just simply have problems in the economy. Larry Summers wrote a famous paper about secular stagnation in which he theorized that there is too much saving and not enough investment out there to really kick the economy forward. So, what do you think about the Summers idea about that, and what do we do?
Well, this goes back to the comment I made earlier about the low neutral rate. So Larry Summers said we have too much savings and not enough investment. If you have a lot of savings and not a lot of investment, interest rates will be low because the interest rates clear savings and investment. So why is there not, the question is not why is there a lot of savings? The question is why isn't there more investment? And this is a little bit of a conundrum. So productivity has been low in America and in advanced economies all around the world. And part of my explanation for that is a lot of the stuff we've been innovating in the last decade, like Twitter and Facebook, it's not that useful. I mean, it's a good way to waste time, but it's not exactly productivity enhancing. Okay? So where are the breakthrough new technologies that, go back? So there are some economists who say we just aren't inventing important stuff right now. Doesn't mean we won't in the future. Go back 100 years. Electricity, the airplane, the internal combustion engine, the telephone, the integrated circuit. I mean, these are transformational innovations that have then woven in across society, the fabric of society. What have we done lately? I mean, literally the most important economically, you're not going to like it, so just bear with me. The most important economically, the most important innovation in the last decade or so has been fracking. It has a bigger impact on the global economy than Twitter and Facebook and everything else. And because, here's why it's been so important. It has effectively put a cap on the price of energy. And so when there is a disruption, an attack in Iran or in Saudi Arabia, et cetera, historically you'd see the price of oil spike. And that would be a shock through the whole global economy. But with this new technology, they've effectively put a cap on it. Now, there are other costs associated with it, which the gentleman in the front will no doubt tell us about. I'm not debating that. But where are the other, and by the way, the other thing about the energy industry, it needs a lot of capital. So a lot of capital was flowing into North Dakota and Texas and Oklahoma to develop this. Where are the other big destinations for capital? So imagine if Elon Musk invents some brilliant new technology, really positive technology, positive investment, but it takes $5 trillion to exploit it. But if it's really productivity enhancing, you'd see interest rates rise. Because we're saying, wow, now we can make these investments, now savings and investment will balance at a higher level, interest rates will be higher, but it's being put to productive use. So the bigger question is, I mean, we're at the University of Minnesota. Our universities, right, developing new technologies that can really drive economic growth for the next 10 years, the next 20, 30, 40 years. Where's that going to come from? Your guess is as good as mine.
Okay, Anastasia.
I have a question about the stock market and something called the Fed put. It used to be called the Greenspan put after the Fed cut rates in the '87 stock market crash. How important should the stock market play in monetary policy, and are you concerned about unintended consequences of investors knowing the Fed have their back?
We are, I am, but we have to do what's right for the US economy. And I'll just give you an example. So this last week, stock markets have been going up and down. They fell precipitously late last week and on Monday, et cetera, Tuesday. To me, much more important than that signal was the signal the bond market was sending us. The bond market rates were falling, and when long-term bond yields fall precipitously, they're telling everybody that the bond market is bearish about growth prospects, that the US economy appears to be slowing down, we appear to be hitting a rough patch. So to me, it wasn't simply the stock market. A more important signal was the signal that the bond market was sending us about economic outlook. I don't really care if stock investors lose money. What do I care? Stock markets go up, stock market goes down. You know, the tech bubble, I go back, people say, well, you should raise rates to clamp down on the stock market. Some people say that, especially people on Twitter who are watching right now. In 1996, Alan Greenspan said, there's irrational exuberance in the stock market. The stock market is overvalued. He said that in 1996. The stock market then for the next 4 years went like just like this, and then the tech bubble burst, and it caused a mild recession. If Greenspan had said in 1996, I know the stock market's overvalued, I'm going to raise rates to prevent them from climbing any further, he would have had to raise rates so much that that would have been much more painful for the economy than the recession that actually happened in 2001. So we have to be very careful about which of these things we go after, because monetary policy is such a blunt instrument. It affects the entire economy. So it's like saying, well, you're worried about the stock market climbing. Is it worth putting the economy into recession to try to get the stock market under control and throwing millions of people out of work? Boy, that is a tough call. I don't want to say never, but the bar is going to be very high before I'm going to advocate for putting the economy in recession to try to deal with risks that I see in the stock market. If stock investors lose money, they lose money.
Okay, I have one over here.
I'm curious about corruption and how that affects the economic models. So, although my understanding is small about all that happened in 2008, I am wondering if the Fed, I mean, essentially, you may not control things, but you're taking all kinds of factors into consideration, and you have to, right? So there's really nothing out there that doesn't, in some ways, factor into what do we do now to help. So there's two things that seem to me to be maybe not realistic. One is we seem to have a high degree of corruption and difficulty in trust in our financial dealings. And I know that's kind of vague, but the credibility of anything is starting to get less. And the second is this idea that productivity can infinitely increase that seems to be built into the model.
There's a lot under your questions. I would say corruption is clearly a problem everywhere, but I would say, as much as we see it in America, one piece of good news, it seems to be worse at most other places. And so it'd be ideal to have a corruption of zero, and when we see it, we need to shine a spotlight on it, we need to prosecute it to discourage other people from following that path. I think we do a decent job of that, not a perfect job of that, here in America. One of the frustrations everybody had from 2008 is that nobody went to jail. Right? That's still a frustration that everybody shares. Part of the reason, and I share that frustration, part of the reason nobody went to jail is because it's not illegal to be stupid. And there were a lot of stupid people on Wall Street taking ridiculous risks that they didn't understand, that we all had to pay the price. But unless the prosecutors could prove that they were lying or fraudulent, it was very hard to make a case, because stupid is unfortunately not illegal. But there's no question there were people doing fraudulent things too, and I'm frustrated too that they didn't get prosecuted. In some cases, the underlings went to jail, but the bosses didn't, which is just the most outrageous of all of it. Right? If all the underlings knew, then the boss knew what was going on. What was the second part of your question? Productivity. I'm optimistic. I mean, I actually think the human mind is always inventing. We're always trying new things. And whether it's our healthcare technology is getting better every year, or our computers are getting better, or our other science is getting better, I personally don't see any limit to the possibility of human ingenuity. It may not happen as fast as we'd like, and it happens in fits and starts, big spikes, and then time to digest it. So I'm optimistic.
Okay, I have one clear in the back here.
Somewhat related to an earlier question, did the research in the disparity of educational outcomes assess how much of that disparity arose from the quality of the education versus the circumstances of the underperformers? For example, low nutrition in a low-income house, or lack of parental support for education.
Yeah. All of those other factors are really important. There's no question. Poverty is a factor. Housing is a factor. Nutrition is a factor. Who your parents are is a factor. No question. But if you look at some other states, I don't have the data here. You go on our website. Other states are making progress, real progress. Florida went from like 34th or 35th in terms of 35th worst gap to 6th in 20 years. They have poverty too. They have malnourished kids too. They have housing problems too. So I'm not dismissing those. Those factors all matter a lot. But the education really matters.
Okay, on stage you have one clear in the back there.
This is actually building on his question, because I was going to ask kind of the same thing, but our achievement gap, how much of that has to do with are our highs higher than other states, and which causes a gap, or are our lows lower? And then also specifically, what exactly are the other states doing? You know, like Florida did it, what exactly are they doing? And I guess the third thing, exactly what do you guys propose? Outside of this language, do you propose more charter schools, more early child education, exactly what?
So it's the highs are not higher. It's the lows are lower, generally speaking. We are very, Justice Page and I were very careful in this language. We're not educators. We're not here to tell you that we have exactly the right answer. What we want to do is make education the highest priority of the state so that all of the answers are available. And by the way, the answers are going to be different for different kids in different communities. Kids in St. Paul may need something different from kids in Bemidji or kids in Rochester. Let the families and the teachers in those communities determine what their children need in order to be successful. But specifically to your question, just take Florida as an example. They did a whole bunch of stuff. They did things focusing on teacher training, more investment in teacher training. They did things on making sure that kids were actually showing up to school. And you got to show up to school if you're going to try to learn. They shrunk their class sizes. They did early childhood education. They had a whole suite of policies that they put in place. I can't tell you it was this one policy or that, but the collective policies, the collection of them, have really made a big difference.
Okay, I have one for you, clear over on the right side here.
So if I understand it correctly, the rationale for the Fed being involved in this education is because ultimately it affects employment, which is part of your mission?
Yes.
So are you doing similar things in other employment areas like minimum wage, paid sick leave, which is very important right now, maternity leave, and the whole income gap?
We're doing different research in different of those areas. So as an example, Minneapolis and St. Paul have both voted to raise their minimum wage over time to $15 an hour. Both cities have selected the Minneapolis Fed to do a long-term economic impact analysis on what are the actual effects of raising the minimum wage. Right now, the research is unclear. Right now, some research says if you raise the minimum wage, it's great, workers do much better. Other research says if you raise the minimum wage, workers' hours get cut, and it turns out workers aren't any better. So the research is unclear. And they came to us and they said, you're the one entity that everybody will trust that you'll do the analysis fairly. So minimum wage is something that we are taking on, not advocating a specific proposal, rather doing the economic research. So there are many other areas that our researchers are engaged in. In fact, I don't even know all of them. But education is just such a huge driver. I mean, of all the tools we have to break the cycle of poverty, there's nothing more powerful than education. And that's why I'm spending a lot of my time on this.
Okay, I'm going to have one for you right here in the middle. Very patient people. I appreciate it so much.
Earlier, you spoke a little bit about your opinion on immigration. And I know that our state demographer is very, very concerned about Minnesota's economy being so dependent upon changing immigration policy. So what can we do as a state and as a country to address this issue? I mean, do we just have to wait for the next election to come along, or what can we be doing to try to change that, because it's really critical?
I actually think this is less of a partisan issue than it seems. I've met many people, conservative Republicans, who say this is about economic growth. And what they've said to me is they want to address illegal immigration, which is a concern for them and for their constituents, but we need legal immigration to feed our economy with workers and with consumers. So I actually think the economic lens, all I'm bringing, like I go around the region and I always say to people, this is math. You know, we're having fewer kids. So you can either, one, you can accept slower growth. Number two, you can try to do what Japan is trying to do, and that's subsidized fertility. You pay families to have more kids. By the way, it doesn't really work. And it takes 20 years, if it does work, to grow a new worker. Or number three, you can embrace immigration. Which of those three do you want? That's math. I'm not here to offer you a moral judgment. I'm just doing the math for you. Only one time have I had someone who's heard that and said, you know what, I'll accept slower growth. Vast majority of people, when they hear that, say, wow, turns out immigration is really important to our economic vibrancy. So I'm just trying to make the economic argument, and then I'll leave the moral arguments to elected leaders. What steps can we take? I mean, I think you just need to express your views through our political process on why you think this is important. I mean, I don't know anything else other than that, because it does need to be decided upon ultimately by the federal government.
Okay, Anastasia, we're here.
You were talking earlier about the independence of the Federal Reserve and the independence of each local Federal Reserve. What I'm curious about is your thoughts about the Federal Reserve Chairman and the huge amount of pressure that I see President Trump putting on Powell to pretty much implement the types of policies that Trump thinks would be the best for the country, as opposed to what Powell may think. And I wonder if you could just comment on that.
I'll say, you would all be really proud if you got to look behind the curtain and see what motivates people at the Fed. Our true north, we have different policy views amongst ourselves, but our true north that we all agree on is that data and analysis and rigorous economics needs to drive our decision making. And the louder the political heat gets turned up, the more we all hug data and analysis. And Chairman Powell is doing a fantastic job, in my opinion. I don't think anybody could do a better job than he is doing in leaving politics aside and focusing on what our jobs are. And we all follow him in that and agree with him and respect him for it.
Follow up over here.
Just one quick.
Sure, go ahead.
Can he be replaced by Trump, short of running out of his term? Can he be fired?
No. I think. I mean, there's some legal questions people have raised, but I think it's pretty clear that he has a 4-year term and could be removed for cause, but not just for policy difference.
Okay, question over here.
You've made the statement that the Fed is influencing the entire economy through its monetary policies. To the extent that we've seen a growth of non-bank banking activity, Walmart opening a bank essentially, certain private equity entities in the business of lending, a great deal of lending. Is the Fed doing anything about that? It seems counterproductive to what your mission is, to have those things outside your purview. Are you doing anything about that to rein those in?
Well, there's a couple angles to what you just said. One is we're monitoring it because they are participants in the economy, and we do look at and we do measure how much lending is going on within banks and within non-banks. So it is part of our analysis as we think about what's happening in the U.S. economy and what the trajectory of economic growth is. The more difficult question is from a bank regulation and supervision perspective, because we don't have direct oversight into these non-bank entities, and it's certainly possible that a systemic risk could build up in one of those non-bank entities that could become a risk for the U.S. economy. So there's a lot of collaboration between the Fed and the SEC, and there's something called the FSOC, Financial Stability Oversight Committee, that the Treasury Secretary chairs, that tries to take a look across the whole financial system, not just at the banks that the Fed regulates. So I would say it's an imperfect system that we have right now. A lot of people are focused on it. And could it be possible that the regulatory system needs to change over time to keep up? It's certainly possible, but it's something we're definitely paying attention to.
Okay, one back here in the aisle.
Back to the early education program. Hasn't there been some programs done on a small scale? I'm thinking of Art Rolnick, and he's done early education. There's a nutrition component, there's a home component, there's a family component. Family has to be involved to make sure that the program is a complete program. I just wondered if that's something that you're looking at in terms of the type of program that might be offered that might have hopes of succeeding?
Well, we think, and the Art Rolnick work, he was at the Federal Reserve. That's the early education work that I talked about earlier that we absolutely think is really important. And we advocate for it and we support it and we think that that's a great place. To me, this amendment supports that. This amendment says all children. It doesn't say all students. So this amendment goes as early as you need to go for what that child needs. So early ed to me is one way of using this amendment to drive change, to make sure kids have the early education that they need. To me, early ed is not enough. It's a really important piece of the puzzle. It's not the whole thing. This amendment is trying to be broader than that, but early ed is clearly part of that.
Okay, Anastasia, question over here.
What's the relationship between the FDIC and the Federal Reserve Bank, and who makes up the Federal Reserve Bank?
Who makes up? So the Federal Reserve Bank in Minneapolis, we have about 1,000 employees. We're independent of the FDIC, but we both have roles in regulating banks. So there are some banks where the FDIC takes the lead as the regulator. There are some bigger banks that the Federal Reserve takes the lead as a regulator, but the FDIC also regulates them because they provide deposit insurance. There's another regulator called the OCC, the Office of the Comptroller of the Currency. They also regulate a category of banks. So these agencies on bank supervision work actually pretty closely together to try to make sure that we are getting the full view of how the bank is operating. But the FDIC is a separate agency from the Federal Reserve.
So Neel, I'm going to go back to a comment you made before, and I know you're a proponent of this forward guidance, and it seems like in the past, the Federal Reserve has maybe given us a look 3 months ahead. Maybe, they talk about it might reduce interest rates in the next 1 or 2 meetings. You were, I think, thinking about much longer terms than that. So how much progress are you making with your colleagues about actually giving forward guidance?
There's been actually, we're debating right now, because we're in this low interest rate environment, again, go back to what I said earlier, the neutral interest rate is low. We have to deal with the reality, what we face in the economy, and the neutral interest rate is low. So people are worried, how much room do you have to cut if there's another downturn? So we're looking at our toolkit right now. We're doing a big comprehensive review of the tools we have and how we would use them. And one tool that some of my colleagues have spoken about publicly is, we could make a commitment if we get back down to zero to stay at zero until inflation gets back to our 2% target. So I called for something like this last year where I said, let's commit not to raise rates until we get inflation back to our target. Let's not raise rates ahead of it. That's a mistake that we've been making. Let's prevent ourselves from making that same mistake. So I think I've heard some of my colleagues say things that are similar that I think are pretty encouraging. But we'll see. The review is ongoing, and we'll see what the review comes out with.
Good. Okay, so we're, before we get to our last question, we'll put it up on the slide. Next month, it's actually going to be spring in April when you come back. It's not going to snow like it did today. It was pretty amazing to see that out there. But we're very happy to host on April 5th Dr. Jaime Mariano. He's a Perlman Professor of Oncology and Comparative Medicine here at the university. His presentation, very interesting, dogs, dinosaurs, elephants, and kids. Demystifying and curing cancer. So come back for that. I hope you do. So for our last question, I'm going to do something a little different. Many of you know and see Anastasia wandering around here with a microphone and so forth. She never gets to ask questions. So she asked me if she could do the last question tonight, and I graciously agreed. I think she has a very interesting question for you.
I'm nervous now.
Yeah.
Well, I wanted to go back to feedlots, actually. No, actually, as the person who has been working for years, plural, to bring you here this evening, so I'm so glad you're here.
Thank you for inviting me.
I happened to learn a lot about you over the course of that time, and one of the things I learned was that one of your heroes is Ulysses S Grant. And I just was wondering if you could tell us a little bit about why Ulysses S Grant and tell us a little bit about what the connection is for you.
Thank you. Appreciate that. So after I spent time in Washington, 06 to 09, under Presidents Bush and Obama, I got really fascinated about where our government came from. So I started reading a lot of U.S. history, read about a dozen books on the Revolution and the founding and the Constitution, and then I went forward in time and I stumbled into the Civil War and was just blown away. The Civil War is just so fascinating. And then I stumbled, of course, Lincoln. I mean, Lincoln is probably number one. Everything I've learned about Lincoln, what I love about Lincoln is he came from nothing, brilliantly talented, used his talent for a cause greater than himself, and was absolutely the right person at the right time in our nation's history. But it turned out he had a partner, ended up having a partner that was really important, and that was Ulysses S. Grant. Much of the Civil War was Lincoln searching for generals who could lead. And he went through failed general after failed general after failed general until he found this guy who also came from nothing, who had a mediocre career in the Army, who allegedly had been thrown out because he was a drunk, who was basically selling firewood on the street to feed his family. And when the Civil War broke out, he said, you know what, I might be able to help. I've got some experience in the Army. And he started helping, and he started leading, and he started winning, and he started winning. Excuse me. And the thing I love about Grant is he overcame so many obstacles in his journey. Every time he had success, other generals came out to try to take credit from him. Other generals said, no, he doesn't deserve the credit, I deserve the credit. But Lincoln saw through all that and kept promoting him and kept promoting him and kept promoting him. So Grant was instrumental in winning the Civil War. Then when he became president, 4 years after Lincoln died, he was probably 50, if not 100 years ahead of his time on civil rights. So he promoted Native Americans into senior positions. He promoted Jews into senior positions. He promoted freed slaves into senior positions in the government, which had never been done before. So what I love about Grant is just he came from nothing. He was so flawed and so imperfect in so many ways, but had this amazing strength that led him to achieve great things for the country, ending slavery, winning the Civil War, and then was just such a foresighted leader when he was president. So that's what I love about Grant. I would encourage you to read about him. I've read a lot about him. And the last thing I'll just say is a year ago, a little over a year ago, my wife and I had our first child. And my wife was kind enough to allow me to name our daughter after Ulysses S. Grant. So her full name is Ulysses Sabine Kashkari. We call her Yuli for short. And we figured if she doesn't like the name Ulysses that her father gave her, she can use Sabine, which is more of a traditional woman's name. So thank you for asking the question.
Thank you very much.
Thank you for having me. Really appreciate it.